Hey guys, welcome back. If this is your first time here, I'm Neil, the Adventurous Investor. On this channel I talk all things investing, business, finance, personal finance, and anything in that sort of nature. Just a quick reminder guys, if you enjoyed today's video, hit that like button, it'd be much appreciated. And if you want to see some more videos like this moving forward, then hit that subscribe button. I've noticed in the back end on the analytical side of things, only about 10% of your subscribers. So yeah, definitely don't forget to hit that subscribe button if you want to see some more videos like this moving forward. Anyway, today guys, I'm going to be talking about the 7 key fundamental ideas that the best in the game value investors use before they make any investment on the stock market. Alright, so a lot of these books I've been listening to the last 6 months come from recommendations from another YouTuber called Investing with Tom. Highly recommend you jump over and check out his channel. Real good value-based investor from New Zealand. And in one of his videos he just talked about a lot of books that he has stacked up on the bookshelf behind him, and he just quickly rattled through the whole list. And I've been working my way through that entire list basically. Most of it just through Audible. Definitely recommend you jump on Audible and listen to as many books as you can. It's a super good way to take in as much knowledge as you can from these guys that are the best in the game, okay? Just a couple of standout favourites for me would be Mohnish Pabrai's The Down Investor, The Education of Value Investor from Spier, Peter Lynch's Walk Down Wall Street, Joel Greenblatt book, that little book that meets the market. All great books, highly recommend them. Definitely get out there and listen to these, or go down to your local bookshop and pick these up. Anyway, so this is my sort of 7 key traits and key ideas that I've sort of learnt from all these different books, and they all sort of singing off the similar sort of page of music, but in this video I'm just going to be breaking down the 7 sort of key things that I've sort of taken away, my key findings from these books. Okay, so number 1 is that they all invest in companies that are easy to understand and within their area of competence, okay? So they have a deeper understanding or knowledge on how the business produces profits, okay? Quite often these businesses can be maybe even boring businesses. No one's talking about them. They're not the hot topic of the month. Even Peter Lynch in his book, he quoted, he loves investing in these businesses that no one loves talking about. He used a funeral home or a crematorium as an example, because no one loves talking about death and that sort of thing. So these are the sort of businesses that he loves that everyone hates talking about. So these are the sort of businesses that he looks for, is ones that, no one's talking about it. It's not the hot topic like Tesla is at the moment. Nothing against Tesla or Elon Musk or anything. I think it's amazing what he's doing, but it's the hot topic at the month. Everyone's talking about Tesla, which is reflected in the share price, obviously. So that's gone crazy. Okay, so that's number 1 on the list. Number 2 on the list, they like to invest in companies that have a deep moat. Okay, so what do I mean by this? Businesses that it's hard for competitors to take away market share from them. So I'll give you a couple of examples. So let's take the airports for example. Not here in Australia, New Zealand, but globally at the moment, no one's really flying anywhere, so the share price has dropped off a lot. But if you look fundamentally, they're still good businesses with quite a good moat. It's hard for a competitor to come in and build a bigger and better and cheaper airport right next door to them. Obviously it can happen, but it's going to take a lot of red tape and government legislation to get through in order to build another airport just up the road or something like that. So they have quite a good competitive advantage over other businesses, that they have quite a reliable deep moat there that it's going to be hard for a competitor to take away from them. Whereas I'll give you an example of the car manufacturers like Toyota or GM Motors or these sort of big car manufacturing companies. Their moat is slowly getting narrowed due to Tesla at the moment, okay? Like I talked about earlier, he's bringing a lot of electric vehicles online, so they're widening their moat with bringing all these electric vehicles online. So that's where Tesla's moat is widening, and these traditional car retailers, unless they change their business model and start bringing on a lot more electric vehicles, which they are starting to do as well, their moat will thin, and where Tesla's will widen. Okay, businesses always moats are going wider and thinner, so they like to invest in businesses with a nice deep wide moat that's sustainable for years, okay, 10, 20, 30 years sort of thing. So these are the sort of businesses that they like to invest in. Okay, so number 3 on the list, they like to invest in distressed industries and distressed sectors, okay? Especially where there's been mass sell-offs recently with whatever may be happening in the world. Perfect example at the moment with the whole health crisis we're all living through. Obviously the travel sector, the tourism sector, the hospitality sector are all heavily affected by no one's going anywhere, no one's going out and about, the whole world's on lockdown still. So these sort of industries have been getting affected a lot. But if you dig a bit deeper, there's still some very good profitable businesses out there that have just sort of been dragged down with this as well, okay? So these are the sort of industries and sectors that they like to invest in that have been heavily trodden down by the market for whatever reason. There may be scandals, there could be disasters, there could be crises, whatever's going on that's dragging these share prices down. They like to look in these sort of areas, okay? Okay, so number 4 on the list, they like to invest in businesses that have a low PE ratio, okay? A price to earnings ratio that is low. Okay, so what do I mean by this? I'll give you a quick example. So let's say corner store down, your little dairy down the road from you, the owner wants to sell and he's selling it for $100,000. That's for the whole lot, the shop, the inventory, everything. and that shop produces $20,000 a year in profit. This is after all the bills and everything's taken out. That will give you a PE ratio of 5 to 1. So that's quite a low PE ratio, okay? If you look at the other companies out there on the market, I'll use Tesla as another example. Earlier in the year, I think it was trading over 1,000 to 1, okay? So they like to look at businesses that have a low PE ratio. This is a good indication that the business is selling for cheap. Okay, so number 5 on the list, as well as a company that has a low PE ratio. This is coming from Joel Greenblatt's Magic Formula book. He also likes to invest in, they like to invest in companies that have a good management in place and that is growing the business, okay? They're getting a good return on assets or a good return on invested capital. So what does this exactly mean? Basically, the management are good at investing the company's funds or at acquiring new assets and growing at a rapid rate, okay? So the higher this number, the better off you are. If you're getting a return on assets is sort of 15, 20, 25%, that's great. So just remember these two key figures, low PE ratio and a high return on assets or a high return on invested capital. These are sort of basic fundamentals that Joel Greenblatt uses in his Magic Formula, okay? Check out his website, magicformula.com, if you want to just get a bit more of an understanding on that. Great sort of resource for using as a screening tool if you want to look at different stocks, all only in the US though, okay? So there's no Australian or New Zealand companies on there, so definitely get on there. He's got a whole screening looking for low PE companies with a high return on assets, and you basically go through the screener and invest in those. But obviously there's a lot more to it than just that, but that's what his sort of book was talking about. So number 6 on the list, they like to invest in businesses with a nice healthy balance sheet. So what do I mean by this? Businesses that are carrying minimal debt, they have a good amount of assets that are owned predominantly freehold, that isn't much debt attached to those assets. Also, businesses that don't require huge capital to obviously keep it growing and just to keep it going, okay? Which was a bit odd when Warren Buffett bought into the airlines. Obviously, they're quite a capital-intensive business, airlines, which he then obviously sold off this year. So, a bit of a strange move there, but obviously he saw something there that he liked the look of. Even though generally the airlines are quite a capital-intensive business, they like to look at businesses that don't require huge capital to grow. But this is not always the case. A lot of businesses require a lot of capital in order to grow the business. But anyways, nice healthy balance sheet is something they all like to look for, where the net tangible assets of the business sometimes quite often outweigh the actual share price that the current market is putting on the shares. So a few things to look at there on the balance sheet. Okay, so number 7, the final point on the list, is they like to invest for the long term, okay? They're not in this for a quick week or 6 months or anything like that. Ideally, they want to invest in good, sustainable businesses for a long period of time, 10, 20, 30 years sort of period. Look at a lot of Warren Buffett's holdings. He's had those for years. We're talking 20, 30 years, okay? So these are the sort of businesses they like to invest in, good, sustainable, long-term businesses. And they like to buy these at below intrinsic value. So what do I mean by this? Basically, they like to buy a company at a margin of safety to what they perceive the actual value. So let's say they think the value of a company is $100 a share, they'll like to try and pick that up for $50 a share. So that's the sort of margin of safety they like to put on their purchases when they're buying them, okay? In the early 70s, a lot of these business schools were coming up with this theory that markets were efficient, okay? Efficient market theory. So everyone was coming fresh out of business school of this understanding that the markets are an efficient place and everything's bang on value where it should be. You know, they take into account all the business news and everything that comes out about those particular companies, and everything's pretty much bang on. But Warren Buffett did incredibly well for a few years there because no one was looking at the fundamentals and the balance sheet and the income statement and the cash flow statements of these businesses, because they just thought there was no point, everything's bang on. And he had a couple of cracker quotes which I really love. First one was, he says, if the markets were an efficient place, he'd be a bum on the street with a tin cup sort of thing. And he also said another great quote which I really enjoy as well. He said, you know, playing with someone that thinks that the market's an efficient place is like playing bridge with someone that thinks it doesn't do any good to, you know, look at the cards. Warren Buffett and a lot of these sort of big value time investors, they love playing bridge for some reason. I don't play bridge, but a lot of these guys seem to play bridge, so I might look at taking up bridge. If you guys play bridge, drop it in the comments below, because I've never really played much bridge, but it seems interesting that they all seem to play bridge. Anyway, look, markets generally, they are pretty much bang on most of the time, but there's a big difference between mostly efficient and fully efficient, okay? And that little edge there, that's where you can really sort of dominate if you have a good understanding of all those sort of 7 principles that I sort of went over, which takes years. I mean, look, I'm not saying I'm a master at any of this, but this is just things that I'm trying to really learn and put into my own investing, because I'm trying to learn from these guys that are really good at what they do. And what have they done? Well, like what sort of things were they looking at when they were investing in businesses? So I hope you enjoyed today's video, guys, and if you enjoyed it, make sure to hit that like button, be much appreciated. And if you want to see some more videos like this moving forward, obviously hit that subscribe button, and we'll catch you guys in the next video. Cheers, guys.